In this video, I'm going to show you why you're wasting your money by not investing in index funds. For the large majority of us, index funds are the best way to save for retirement or just to generally invest in the stock market. But Ravi, aren't index funds for baby boomers? Man, I don't invest in index funds. I know how to pick stocks. I'm trying to hodl, bro, and you're talking about index funds? Yes, index funds, and in this video, I'm going to show you all why index funds are the best way to invest in the stock market. 80%. Now, why is this number on the screen? Well, I'm going to let you guys in on a little secret that not too many people know about. CNBC recently did a study and they found that 80% of all actively managed US stock mutual funds underperformed their benchmark in 2021. 85%. Now, why am I showing you this number? Well, this study also showed that in 2021, 85% of US large cap stock funds underperformed the S&P 500. So Ravi, you're telling me that instead of paying super high expense ratios to invest in actively managed mutual funds that can't even outperform the S&P 500, I should just invest in the S&P 500 through an S&P 500 index fund? Yes, that's exactly my point. But to be honest, there are some actively managed large cap mutual funds that can outperform the S&P 500 during a given period of time, and kudos to them. But remember, only 15% of actively managed mutual funds managed to outperform the S&P 500 in 2021. And the truth is that outperforming the S&P 500 year after year after year is even harder. Yeah, you may be able to do it for 1 year, but can you do it for 5 years? Can you do it for 20 years? What about 40 years? Fund performance is a really important part of investing, but the reason that I made this video is because of expense ratios. 0.5% to 1%. That's the average expense ratio that an actively managed mutual fund charges in the United States. Now, some funds might be slightly lower, and some funds definitely have a higher expense ratio. 0.03%. That's the expense ratio for VOO, which is the Vanguard S&P 500 Index Fund ETF. Let me quickly show you guys a simple real-life example using these expense ratios, and it's going to blow your mind. Now, if these examples don't prove to you how awesome index funds like VOO truly are, then I truly don't know what to tell you. I went to investor.gov and used the compound interest calculator to show you all how much investing in an S&P 500 index fund actually saves you over the course of your life. On the left-hand side, we have VOO, which is our S&P 500 index fund. And on the right-hand side, we have a typical US large cap mutual fund that's benchmarked to the S&P 500 index. I input a $5,000 initial investment for both funds, and then I input a $350 monthly contribution to each one of these funds. In terms of the length of time that I'd be contributing to this fund, I input 35 years. I made the assumption that my average viewer is 30 years old and they have 35 years until retirement. For the index fund, I input an estimated interest rate, or in this case, return, of 9.97%. I made this assumption based on the fact that the S&P 500 has returned roughly 10% over the last 100 years. And if you subtract 0.03%, which is the expense ratio of VOO, you get a 9.97% rate of return. And for the mutual fund on the right-hand side, I made the same exact assumptions in terms of a 10% annual return, but I subtracted 0.75% for the expense ratio. With an S&P 500 index fund and 35 years, you would have $1.269 million in your account. And with a mutual fund, assuming the same exact performance, you would have $1.069 million at the end of 35 years. The point of this example and the point of this video is to show you that expense ratios matter. And the more money you invest, the more these expense ratios matter. For example, if you started with an initial investment of $25,000 and contributed $600 a month, after 35 years, the S&P 500 index fund account would have $2.633 million in it, and the mutual fund would have $2.196 million in it. In the first example, you spent roughly $200,000 in just fees that went straight to the fund manager. And in example 2, you spent roughly $500,000 in fees. Ladies and gentlemen, that is the power of investing in an index fund like VOO. Not only does the average person save hundreds of thousands of dollars in fees, investing in index funds doesn't require research, it doesn't require stock selection, and the S&P 500 index fund actually performs better than 80% of mutual funds that are trying to outperform it. I'm really trying to get people to take index funds seriously. I see so many people hiring advisors and trying to pick stocks and trying to pick mutual funds. You really don't need to do all of that. Why would you pay someone 25 times more to try and beat the S&P 500 index when they can't do it 80% of the time? So save your money, start investing in index funds, and start building wealth the proven way. And S&P 500 index fund investing is a great way to start. And VOO isn't the only S&P 500 index fund ETF out there. There are numerous other offerings, and they all virtually do the same thing. VOO just happens to be my favorite. Well, ladies and gentlemen, thank you all for watching this video. And if you have any questions, please be sure to ask them in the comments section below. And please remember to like this video for the YouTube algorithm, and please consider subscribing to my YouTube channel for more free financial education content like this that is meant to benefit you and your wallet. Happy Friday, everyone. Enjoy your weekend. I will see you all next time.